People are spending $400 on an umbrella when they have no job. They're going into debt, credit card debt, to buy lottery tickets because some states let you buy lottery tickets on a credit card, and then they're praying to get approved for a store credit card so they can save 15% off of their order, and now you're wondering why you're broke. What's up, everybody? I am Jaspreet Singh from theMinorityMindset.com, and welcome to The Minority Mindset. 78% of Americans are living paycheck to paycheck. That means if you walk out of your house right now and you look down the street and you look at your neighbors, 8 out of 10 of your neighbors don't have a couple $1,000s in their bank account right now to protect them from a financial emergency. It doesn't matter where you live. This is the reality of what's going on in America right now. The majority of people are broke. I know this is going to hurt a lot of people's feelings, but there's a lot more to this than just how much money you make. I've talked about people like Earl Crawley on our YouTube channel who make minimum wage and yet have built a multiple six-figure investment and savings account while having kids, while living a life. And then on the other hand, I've also talked about people like Henrys. If you remember, Henry is an acronym that stands for High Income Earner Not Rich Yet, and it's this movement of people that make at least 6 figures a year that are broke because their goal right now is not to save money or invest money, but to live this lavish lifestyle where they're spending all their money to look rich. This is where the vast majority of people get kind of offended, and they put up the smoke screen and they say things like, oh, you shouldn't talk about money like that and you shouldn't worry about money, when in reality, we all use money every single day. If money really didn't matter, then why are you going to work every single day to get a paycheck? Now, I get it. There's a lot more to life than money. Okay, money is just one small aspect of our life. But if you don't understand money, and if you don't have money, you become a slave to money because now you're drowning in debt and you have all these payments that you can't afford. So you're going to work every single day, not to enjoy your life, not to do something fulfilling, but just so you can make your back payments. But if you understand money and you know how to use money and you can grow your money, now you can build your wealth. Now you can take care of yourself and your family financially, and you have more money to help other people and to help your community because you have the resources to do that. If you're broke, you don't have the resources to help other people. When you're broke and you're drowning in debt, the only person that you're helping is your bank because you're paying these insane rates on money that you borrow to buy things that you didn't even need. So many Americans put a lot of weight on luck when it comes to success, and I'm speaking strictly financial success right now. They see somebody who's become wealthy or rich and they say, oh, this person must have become wealthy. They must have inherited the wealth, or they must have just got lucky with their business or their investments or whatever. Luck is the reason why they're successful. If that was the case, why is it that 88% of millionaires are self-made? That means these are people who did not have millionaire parents. These are people who created their millions themselves. 9 out of 10 millionaires out there that are millionaires made it themselves. This is where you can say, oh, they had an advantage, or they had this, or they had that. We can spend the rest of our lives looking for advantages that other people had as to why they could become successful, or you can spend that same time understanding how to use your money the right way. That way you can build your wealth, because there's a system to understanding how to use your money. The first thing you got to do is get your mindset right. I talked about this a little while ago on YouTube, but I was at Speedway getting gas, and Speedway actually had this video on their screen that was talking about how they let you buy lottery tickets with credit cards. And I went in because I needed to get a pack of gum, and there was a lady there who was frantic, who was freaking out because her credit card got rejected when she was trying to buy like $150 worth of lottery tickets. She was buying dozens and dozens of lottery tickets because this was her kind of hope of becoming successful. Spending all your money on lottery tickets or financing this lottery tickets is gambling, and it's a straight path to broke. Not only are you not going to win, but now you're going to be spending all your future paychecks paying off these bad decisions. Wealth is a long-term game, and if you really want to know the secrets to not being broke and the secrets to becoming wealthy, there's 5 things that you need to understand. These are the 5 things you have to understand. First, you got to stop living in a net zero life. Second, you got to avoid the money traps that are out there. Third, you need to know how to grow your money and grow your wealth faster. Fourth, you got to stop living in this game of the fake flex. And 5, you need to understand the game of how money works. These are the 5 things I'm going to be going over in this video, so make sure you watch this video until the end. First, let's talk about living this net zero lifestyle, because this net zero lifestyle is keeping the majority of people broke, and it is holding you back from becoming wealthy. The way it works is like this. The majority of people think, okay, I have $100 in my bank account right now, and if I have $100 in my bank account, that means I can go out and I can spend $100 on a pair of shoes because I have $100 in my bank account. If I have $100, I should be able to spend $100. This is net zero thinking, because if you have $100, you can spend $100. This mindset kills people's wealth, because if you have $100, you cannot afford to spend $100. This is why I keep saying that your income is not what determines if you're going to become wealthy or not, and your income is not what's going to determine if you're going to live broke or not. It's what you do with your money. If you make $100,000 and then you spend $100,000, guess what? You're broke. If you make $20,000 a year and you spend $20,000, guess what? You're still broke. The very first thing you have to understand is you are not allowed to spend every dollar that you have, because some of your money needs to be saved to protect you from emergencies, and some of your money needs to be invested to help build your wealth, okay? If you have $100 in your bank account, you cannot afford to spend $100. This becomes even more true if this money that's in your bank account is not yours. So when I was in law school, I had this friend, or acquaintance rather, that was in my law school with me. And I was talking to him one day about what his plans were for the evening, and then he told me that he was going out to buy a really nice umbrella. I thought it was kind of funny that his evening activity was to buy an umbrella, but I understand it because, we're in a rainy area and it's not fun to go walk around when it's wet outside. So I told him that I bought my umbrella from Home Depot and I paid like $5 from it. And he told me, now remember, this is when we were in law school, okay? He did not have a job. He told me that he wanted to go out and buy this really fancy $400 umbrella. He showed it to me on his phone. And I was like, $400 for an umbrella? Who spends $400 on an umbrella? And he told me that he had this extra cash from his student loans in his bank account, so he wanted to use this money to buy and invest in this umbrella. So when he goes to these attorney interviews, he's gonna look really fancy with his $400 umbrella in his hand. That is net zero thinking on steroids. Now you assume, oh, I have $400 in my bank account, even though this money is not yours. This is money from the bank, and you feel like you need to spend this money because this cash is in your bank. When you live this lifestyle of spending every dollar you have in your bank, whether it's your money or someone else's money, it's even more expensive when it's someone else's money, but when you have this need to spend every dollar you have on things that don't make you money, like an umbrella, you are going to be broke. The solution to this net zero thinking is to create a system where you are not allowed to spend all the money you have. You have to create the system where you know that you have to live below your means. This is where our rule of 5 comes into play. Our rule of 5 says if you cannot buy 5 of them, you cannot afford one of them. So if you have $100 in your bank account, and we're talking about things you don't need to survive, if you have $100 in your bank account and you want to go buy something, you can only afford to buy something that costs $20. Because if you have $100 in your bank account, this $20 thing is what you can afford to buy 5 times over. So if you cannot buy it 5 times, you can't afford to buy it 1 time. Second, let's talk about money traps to avoid, because the majority of Americans are broke and will never build wealth because they're spending money they don't have on things they don't need, which will never make them any money. Sometimes this is obvious. Like I just gave you that example of that person I knew in law school who had money from student loans. This money was not his. This is the bank's money that he spent to buy an umbrella, right? But sometimes this money trap isn't so obvious. When the majority of people say that they can afford something, what they actually mean is I can make the monthly payments. But that's very different than being able to afford something. The simplest example of this is your cell phone, okay? Your $1,000 cell phone that you have in your pocket. So many people are financing this phone on $20, $30, $40, $50 monthly payments because they cannot afford to pay $1,000 for a phone. So they think, oh, I can afford this phone because I can pay $50 a month with 0% APR financing, so I'm not paying any extra money in interest and I can afford this phone, right? But this is a money trap. What happens when you finance something that you can't afford, that you don't have the cash to buy up front? Well, now you're going to be paying this $20, $30, $40, $50 a month for the rest of your life, because every year you're going to get into this trap of buying a brand new phone. And then secondly, you never have the pain of this money leaving your wallet. You think that you just bought a $1,000 phone, but you never had the pain of $1,000 leaving your wallet. All you saw was $50 leaving your account every single month. And so you think now, oh, I bought this $1,000 phone and it's only costing me $50 a month. So let me go and buy this $2,000 laptop that you can't afford, but it's only $85 a month. So now you buy that. And then you buy the sofa that you can't afford because that's only $75 a month. And now you're spending money on things that you can't afford because you think you can live way up here, but you can actually afford down here. You thought you were being financially smart by paying 0% APR, but you just got played, because now you're spending more money on things that you don't need because you never had the pain of money leaving your pocket in the first place. The reason 0% APR is so profitable for businesses is because when you buy things with 0% APR, you never have the pain of money leaving your bank. And so now you can buy a whole bunch of things that you didn't know that you can afford because you can't actually afford it. All you think you can afford is the monthly payments. There's a difference between being able to afford a smartphone and being able to make the monthly payments. There's a difference between being able to afford a brand new car and being able to make the payments. You need to start being able to afford the things you buy, not just making the monthly payments. The goal with the first two things that I talked about, not living net zero and avoiding money traps, is all so you can grow your money and your wealth faster. If you follow the first two things that I just talked about, you avoid net zero, you avoid these money traps, what you're gonna see happen is all of a sudden, you're gonna find extra money in your bank account out of nowhere. Now, what you wanna do with this extra money is you wanna put some of it to work. That way you can grow your wealth faster. There's two terms you need to understand: assets and liabilities. I've talked about this before, so if you haven't subscribed to our YouTube channel yet, make sure you do that. But what you need to understand are assets are things that put money in your pocket. Liabilities are things that take money away from your pocket. Your $400 umbrella, your shoes, your lottery tickets, all these things are liabilities. If you're spending money on something and it's not putting money in your pocket, or if you're not buying it for the sole purpose of making money, it's a liability. The interesting thing about liabilities, though, is liabilities make you look rich, right? When you go out and you buy a fancy new wardrobe, you buy new shoes, you buy a new purse, you buy a new cell phone, you buy a new watch, all this stuff makes you look rich. And so this is what broke people do. Broke people spend all their money on liabilities. That way they can look rich, but they're actually just product rich. You look rich, but you're actually broke because you have no assets. If you want to become wealthy, you got to flip this around. You need to start spending more money on assets, which are things that pay you for owning them. And then once you have more money coming in, then you can afford to buy these liabilities. The first time I really understood this concept of assets and liabilities was when I first started investing in real estate. I was running this event planning business and I had money in my bank account, and I really wanted to buy this BMW. It was the 3 Series, and I really wanted to buy a 3 Series because it looked sweet and it would look really cool with my image. But then for some reason, I was reading books and every book talked about how wealthy people own real estate. I had no idea what real estate investing was. I didn't grow up with real estate investing family members, but I decided, I wanted to try this out. So instead of using my money to buy a car, I ended up buying a small little condo. This condo, as soon as I bought it, about a month later after renovating it, I rented it out for $600 a month, and after paying all expenses, I was left with $250 a month in profit every single month, and I didn't have to physically do any work to get this $250 a month. This was passive income I was getting because I spent my money buying an asset instead of using my money to buy a liability, which was a car. Assets are things that put more money in your pocket. These are the things you need to buy if you want to build wealth. Liabilities are things that make you look rich, but they keep you broke. So now if your goal is to become wealthier faster, you got to spend less money here and buy more assets aggressively. And it doesn't have to be a ton of money to start. You can start with $5 a day or $5 a week or $20 a week, whatever you have. You just got to make these small incremental investments. That way you can buy these assets and build your wealth faster. The reason it's important for you to be buying these assets instead of just keeping your money in your bank account is because at the end of the day, when you're working to make money, you physically are working to make money. When you save money, your money is just sitting like this. It's flat. Your money isn't doing anything. The amount of money you have in your savings account today is going to be the same amount of money you have in a year, assuming you don't take any money out or put it in, right? So if your money is in your savings account, it's just sitting there. But you can't physically always be working, right? You want to live this life where you have other sources of income coming in. This is where assets come in. When you invest your money, you can see your money grow like this. It grows quicker than your money in your savings account, and it grows without you physically having to earn this money. You're using your money as a tool, kind of like a magnet, to go out and attract you more money. And if you want to attract more money, you need to be buying more assets. The more money you put in here, the more money you're going to get back. A simple rule of thumb to help you out with this, if you want to build more wealth faster, is to follow our 5-to-1 rule, which says for every $5 you spend on liabilities, spend $1 buying assets. If you spend $5 at Chipotle, spend $1 investing in Chipotle. If you spend $100 at Amazon, spend $20 investing in Amazon. Now, if you do want to learn more about money management and investing like this, that way you can grow your wealth faster, we have a free ebook on money management and investing that you can read for free when you sign up for our financial education emails, which are also free. You can get a free ebook and start reading our financial education emails by clicking the link up here or by clicking the link in the description below. By the way, our financial education emails are separate from our financial news emails. Fourth, you gotta stop living this fake flex lifestyle. We're living in the day and age of social media where people live their lives based off of what they see on Instagram. Look, more than half the stuff you see on Instagram is fake. There are people that are going into debt to finance the perfect Instagram page because people are going into debt, borrowing money to buy things, that way they look cool on Instagram. This has turned into a game of chicken where people are competing against each other to see who can go bankrupt first. Just because somebody has something doesn't mean they can afford it. Okay? Remember the things that we talked about in this video? The majority of people are broke. Just because your friends are showing off the things that they just bought doesn't mean that they can afford to buy those things. Life doesn't have to be a competition. These big companies want it to be a competition because they know that if all your friends are competing against each other on what you own, you're going to be spending more money at these companies, but it doesn't have to be a competition. You don't need to go out and spend all your money and make every company around you rich. Use your money to build your wealth first. This brings me to number 5. You gotta understand the game, okay? Everybody in the world is after your money, okay? This does not mean that businesses are evil or that they don't deserve to exist. This is just how the game works. Businesses want your money. Apple wants you to buy their AirPods. Lululemon wants you to buy their leggings. Chipotle wants you to buy their extra guac. What you need to do is create this filter, okay? The whole world is asking you for your money. What you need to do is have this filter in place. That way you know what is worth spending money on and what is not spending money on. Because right now, what the majority of people do is they don't have this filter. When they see something they like, they just spend their money. They don't have this filter. You need to know what's worth spending money on and what's not worth your hard-earned money. The goal is not for you to live small for the rest of your life, okay? The goal is for you to live bigger and expand your means. But the only way you can do that is if you have more money for yourself. That way you can invest more money into yourself. That way you can have more money attracting you more money. And when you have that, that's when you can go out and live a bigger lifestyle. You can buy the nicer things, you can have the nicer car, you can have the bigger home. But in order to do that, you need to make sure you can afford it first. That way you're not stressing about the payments. The goal of the game is to become wealthy. That way you can buy all the nice things you want without worrying about the price. But you can never do that if every time you make a buck, it's constantly just going out. You need to know when it's worthwhile for you to part with your money. But this also goes both ways, because once you understand the game and you understand how money works, that's when you're going to want to fuel your financial system, because now you understand, okay, I need to use more of my money to buy assets, investments, which are things that pay me. And if you really want to ramp that up, then you're going to need more money coming into your financial system. That way you have more money to invest and you have more money to grow your wealth faster. And the only way you can do that is to come onto this side of the equation, the producer side of the equation, and learn how to create more income. This is going to depend on what you like. Maybe you're just going to work overtime at your job. You're going to try to get a promotion. You're going to try to get a raise. That way you can earn more money. For some of you, this might be starting a side hustle. Maybe you have a side cake business. Maybe you become a freelancer. You just have this thing on the side that you do to earn more money. That way you can build your wealth faster. And for some of you with the entrepreneurial bug, this is the opportunity for you to go out and understand how to create value. That way you can create a product that people need that improve people's lives. The name of the game is not spending money whenever you can and then trying to find steals or deals that are not actually deals. One time I was at the mall before this whole pandemic happened, and there were these two girls in front of me in the line to check out, and the cashier asked them, would you like a store credit card because you're going to save 15% off your order? I forget which store this was now. Maybe it was Macy's or JCPenney. And these two girls were like, yeah, that would be great. And then the cashier starts looking up the credit information, and these girls were literally praying that they would get approved for the store credit card. And when the cashier came back and said that you're approved, they literally started dancing with joy, right? When you have that, you are just being bombarded with these places, these companies that want your money, and you're just giving it to them as soon as you have the opportunity. You got to stop living like that. You need to understand the game. That way you can keep more money for yourself and build your wealth first. If you want to get your finances in order, the first thing you need to do is not hire an expensive money coach or financial planner or financial advisor. The first thing you need to do is just track your money. Once you track your money, you want to make some adjustments to how you're spending your money. Once you make those adjustments, make sure you're implementing those adjustments, and then rinse and repeat. As you start to get your money in order, that's when you can start doing the fancy stuff. Maybe getting a financial advisor, maybe getting a money coach, maybe reading a whole bunch of financial books, maybe then start going out and figuring out how you want to invest your money. But the very first thing you got to do is you got to start tracking your money. And that means I want you just to go out and get a piece of paper, get a Google sheet, use an Excel sheet, does not matter. And at the very top, you got to write your income. Now, if you have multiple sources of income or if you have multiple incomes in your household, write them down here. Where is your money coming in from? Is it your job, your W-2? Is it your side hustles? Is it your business? Is it your investment income? Wherever the income is, write it down right here. That way you know exactly how much money you made over the last month. You want to do this month by month, that's probably the easiest way to do this. Then, once you got a total number for your income, the next thing you want to do is you're going to write down your expenses. Now, same concept. You're going to take out your bank statements. You're going to take out your debit card statements. You're going to take out your credit card statements. I want you to take a look at all of your expenses. And the reason why it's easier if you use a Google Sheet or Excel sheet is because it's going to be easier for you to categorize these a little bit later on. But if you like paper, that's fine. Now, take out all of these and you need to know exactly where every penny went. How much money did you spend on restaurants? How much money you spend on groceries? How much money you spend on vacations? How much money you spend on your rent or your mortgage? How much money did you spend on your utilities? How much money did you spend on Netflix and everything in between? Write each one of these down. Then ideally you will categorize these and then you're going to write down your total expenses. Then below that, you're going to write your other numbers here. How much money did you save? How much money did you invest? And how much money did you give to charity? Once you have this right here, now you have a financial spreadsheet showing you what's going on with your money. Because most people, and I'm just saying this generally, I'm saying this statistically, most Americans, the vast majority of Americans, have absolutely no idea of how much money they're making, how much money they're spending, where they're spending their money, how much are they saving, and how much are they investing, and how much are they giving to charity. Start with this. Once you do this, I can immediately guarantee that as soon as you see this, you're going to want to make some adjustments. I don't even have to tell you what to do. And the reason why is because when you do this, you're grading yourself and you're going to see, holy crap, how much money did I just spend at restaurants last month? How much money did I spend going out on my car last month? How much money did I spend on groceries last month? And immediately, you're going to start making some changes. Because when you see how much money you spend on groceries, maybe you're going to start creating a grocery list. And you're going to say, unless it's on my grocery list, I don't buy this thing at the grocery store. If you see that you spent $600 at Benihana's last month, you're going to say, okay, I'm not eating out this month. I'm going to go and cook my own meals this month. So I don't want to give you a blanket statement of how you start spending your money yet, because I want you to, number one, track your money. Then number two, I want you to make adjustments on how you want to start spending your money. And these adjustments that you make are going to depend on what your financial statements look like. Then number three is I want you to actually implement these things. That means now you have the statement for last month. What do you think you're going to do next month? Yes, you're going to do this again. That means month after month. And it shouldn't take you that long after you do it the first time. The first time, it's going to take you the longest. The second time, it's going to take you a little bit less time. But by the third time, you're going to be able to do it in 15 to 30 minutes. Every month, you want to make a little sheet of how much money you're making and what's going on with your money. That way you can understand what's going on with your money, because it's going to help you make better decisions with your money. Then, it's number four, rinse and repeat. Because now what's going to happen is once you take a look at this 2 months down the line, you're going to have a much better financial grasp of your money. You're going to see how much money you're making. You're going to know what your expenses are like. You're going to have a better control of your expenses. And now you're going to be looking at, how can I optimize my expenses? How many of these bills can I renegotiate? How many of these bills can I get rid of because I'm not using them before? Can we downsize the car? Do we really need a car this expensive that takes premium gas that has $782 a month just in the monthly payment without including all the other fees? Can you downgrade on these items? And these are the questions you're going to start answering when you get to month 2 and month 3, and I don't have to tell you what to do. You have to start with this if you want to get your finances in order, because most people's financial statements look like this. You make money, you spend money, and then you wonder where all of your money went. And then everybody says, oh, okay, well, I'm making some money. I got to get my money in order. I have no real wealth. I have no real investments. I want to get my life in order. I want to have some cash in the bank. Maybe I should start investing my money. And so now you have this financial statement going on right here. And then the next thing that people do is they go open a stock brokerage account. Now I'm going to start throwing some money to the stock brokerage. You put aside $1,000, and now you put $1,000 into the stock brokerage account, and you can say, I'm now going to become wealthy with this $1,000 investment. What stock should I buy? And now you go out and buy a stock that you read online that you think is a good investment. And then when the stock goes down in value to $780, you wonder what the heck is going on in the world. You thought that investing was supposed to make you richer, but now you just lost $200 some by putting your money into what you thought was a good investment. This is how most people become and stay broke. It's not because you're not investing your money into the right places is because you have no system of what to do with your money. Once you got this in order, the next thing you want to do is create a few different bank accounts. I like to say that you need to have at least 3 different bank accounts. A bank account for your spending money, a bank account for your savings money, and a bank account for your investments money. And the reason why you want to keep these in separate bank accounts is because if you keep all of your money in one bank account, how do you know which money is supposed to be invested? Which money is supposed to be saved for an emergency, and which money is supposed to be spent? And you might say, oh, I'm good with the money. I know that this $3,000 that's in there is just for my savings, and this $8,000 there is for my investments, and the other money I can spend. Well, when it's all in one bank account, it's very easy to accidentally spend your savings money, and it's very easy to accidentally finance your investment money. And this is why you want to go out and create 3 different bank accounts. And what you can do now, thanks to technology, is many banks will allow you for free to create an automatic withdrawal and deposit. That way now when you get paid in one bank account, you can automatically have some of this money move to your second bank account. So you have 3 different bank accounts. This is where all your money gets deposited when you get paid. Then, anytime you get paid, you can create an automatic withdrawal and deposit. That way, a percentage of this money goes into your investment money, and a percentage of this investment goes into your savings account. Now, you're separating your money. That way, you cannot accidentally spend your investing money, and you can't accidentally spend your savings money. Now, this is where everybody asks, well, how do I invest my money, and where do I invest my money? I'm not going to go too deep into investing in this video, but we have a full ebook on how do you invest your money at Briefs Media titled How to Build Wealth as an Investor. And this starts from the basics of how do you build the mindset of an investor to how do you save your first couple $1,000s, but then it gets a little bit more advanced, going over different investing ideas. How do you invest for cash flow? What are different investing strategies? How do you spend your money smartly? To then, how do you earn more money? To then, how do you protect your assets? There's a ton of value in this ebook. You can read this ebook completely for free. All you got to do is click the link down in the description below or go to briefs.co/ebook. The biggest shift here when it comes to getting a hold of your finances, turning your money around and becoming wealthy isn't just creating some financial system and building some financial education. It's also about the mindset of money. Because a lot of times we grew up with no financial education and no idea of how we're supposed to use and spend our money. And so most people assume now when you start making money is you got to go out and spend your money. This is America's consumerism mentality. Hate it or love it, that is what it is. And it's great for people who understand this because now you own the businesses, you own the investments that profit when people spend their money. But when you don't understand this, you're the one that's spending all their money, going into debt to make the rest of the country rich at your expense. And that's why it is so important for you to understand this, because if you don't understand this, you're the reason why everybody else gets to drive around in the nice cars. You're the reason everybody else gets to fly around in the private jets and fly first class. You're the reason everybody has those nice homes. It's because you keep spending all of your money. It's because you keep going into debt to make other people rich before you make yourself rich. That means, number one, if you have $1,000 in your bank account, you can't go out and spend $1,000. And that means if you have $1,000 in your bank account, you cannot afford a $1,000 jacket. You cannot afford a $1,000 handbag. You cannot afford a $1,000 iPhone. Because there's a difference between being able to afford something and being able to buy something. See, most people assume that if I got $50 in the bank and I want to buy a $1,000 phone and it's a $40 a month payment, I can afford the phone because I can afford the $40 monthly payment. But being able to afford something and being able to make the monthly payments are 2 completely different things. And now, if you want to be able to actually afford it, that means you got to be able to buy the whole thing without having to finance it. The only exception to this that I would make is the home that you live in. But now, when it comes to buying things like a phone, buying things like a car, buying things like a sofa, buying things like a TV, stop financing it. Buy it with cash. Yes, including that car too. The reason why so many Americans are broke, if you had to just pick one item, it's because of how much money people are spending on their car. More and more Americans now have a $1,000 monthly car payment. I think it was 20% of all Americans who have a car payment have at least a $1,000 a month car payment. That is a whole rent payment for a lot of the country. So now, when you're spending $1,000 a month just on the car payment, the next thing you got to pay for is the expensive gas. The next thing you got to pay for is the expensive insurance. The next thing you got to pay for is the expensive oil changes. And then the next thing you got to pay for is the expensive maintenance on top of all of that. So it's not just a $1,000 a month car payment you got to pay. Now you're paying $3,000 a month just to keep up with this car. So now if you want to break out of that, go out and buy a used car with cash. If you were going to put $8,000 down to go out and finance this nice car, take the $8,000, go out and buy a car with cash. Yeah, it's not as nice, but you don't got to worry about the payments. Now you take those payments and you reinvest it back into yourself.
But then you're going to say, but Jaspreet, if I have $1,000 in my bank account, why can't I buy a $1,000 jacket or a $1,000 iPhone or a $1,000 handbag? I mean, if I have $1,000, I can actually afford it, right? Well, kind of. Yeah, you can buy it. But if you really want to be able to afford it, you can't spend all of your money to buy this thing. That's why one of the things I like to follow is a simple rule of 5, which says if you cannot buy 5 of them, you cannot afford one of them. Now, you start to really change the way you think about spending your money. If you got $1,000 in your bank account, that means the most you can buy is a $200 phone, or a $200 jacket, or a $200 handbag. And that way now you're not spending all of your money. It changes the way you think. Now, at first you're going to say, well, how the heck am I supposed to afford a lifestyle if I start to live so much smaller? Well, you'll find a way. Because if the government were to tax you tomorrow, impose a brand new 30% tax on your income, what are you going to do? You're going to kick, complain, scream, cry, and then you're going to find a way to pay it. And that's exactly what you got to do right now, is you got to find a way in the beginning to live smaller. Now, I'm going to say this again. The goal is not to live small for the rest of your life. The goal is not to sit there and pinch pennies for the rest of your life. Pinching pennies is never going to make you wealthy. Because at the end of the day, a penny saved is just a penny. But you got to start by understanding how to control your spending before you start worrying about how you can earn more money. Because if you start earning more money without knowing how to control the spending, well, now you end up in a bigger financial hole. And this is what we see happen for so much of America, is people work to get a raise, they work to get a promotion, they work to get a bonus, you make some more money, now you start driving a faster car. You live in a bigger home. You go on a more expensive vacation because you make more money. And this is where you got to understand why you're working to make more money. Because what wealthy people are doing in this economic system is you're working to make more money to buy more investments. And if you can buy more investments, these investments will continue to make you money because of the way our economic system works. And now if these investments are making you more money, well, now you can take the money your investments make and start to use that to live a bigger lifestyle. And this takes time to do. The reason why so many people don't want to do this is because, well, it's going to take me a long time to start making any money from my investments. And you're 100% right. That's why I call it a decade of sacrifice. But if you can put in that decade of living smaller and working to earn more money, that way you can invest more aggressively, after a decade, you're going to have a whole new stream of income. Maybe a whole new asset that's producing more money for you that you can start using to live a better life. But most people are not willing to put in that time. Most people are not willing to put in that work. Most people are not willing to put in the effort or make those sacrifices. And that's why most people will never become wealthy. And that's why most people will continue to complain and hate the system. Now, the problem with that is that's never going to actually help you with your financial situation. Complaining and hating and bringing everybody else down and bringing down the rest of the world, it's not going to help you feed your family. It's not going to help you take your kids to Disney World. It's not going to help you buy your spouse the handbag that he or she wants. If you want to be able to have the nice things financially, you got to go out and get more money. And that means you got to understand how to use your money smartly. That's the first step. And that means, number one, you got to understand how to track your money. Once you can start tracking your money, you make the adjustments, you start implementing, and you keep working on this, then you got to figure out how can you control the spending. Once you can figure out how to control the expenses, because now you got the income coming in, you got to control these expenses so you have more money to invest, then is how can you earn more money? And this is where things start to get fun. Because now the question is, how do you go from $40,000 a year to $400,000 a year? And at first you might hear that and say, how in the world can somebody like me go from 40 to 400? It doesn't make any sense. But when you start asking that question, you're going to start looking for new answers. Now you're going to start watching different YouTube videos. You're going to start watching YouTube videos on how do you earn more money? How do you start a business? How do you start a side hustle? How can you increase your income? How can you change your career? How can you get a new certificate? Then you can start doing different things. And as you start doing different things, now you're going to start seeing your income change as well. It's not going to happen overnight. This is a process. Remember, a decade of sacrifice is more than just 6 months. We're talking about a decade of work, effort, time, and learning to put in the work, to put in the effort. That way you can start getting the rewards of your effort after putting in the work, after putting in the time. Most people put in the work for 6 months and say, where's my reward? But you got to keep coming back, putting in the reps, and understand now, what are the questions you got to ask? Because once you can control this, then it's all about how can you grow this. And as you grow this, remember, the key is to grow how much money you're putting into your investments. If you can grow how much money you're putting into your investments, you're going to be able to grow how much wealth you will be able to build. And if you can own more assets, then you also get to buy more freedom. If you want to save your first $100,000, you don't need to live like you're broke and only eat rice and beans for the rest of your life, but there are 5 things that you need to do when you get paid
in this order. That way you can save that $100,000 sooner rather than later. The first thing that I want you to do is to create 3 separate bank accounts. And the reason why I want you to do this is because each one of us have different things that we're good at. Like for example, me, I'm good at how I spend my money. I can control my spending very easily, but I'm not very good at controlling my eating. I like food. When there's food in front of me, I'm going to eat it. So in order to stop me from eating, I don't have the food in front of me, or I'll just eat whatever's there. So I've learned about me that some people are very good at eating, that when they start eating, they can stop themselves before they're full. When I start eating, if there's food there, I will eat it. But when it comes to spending, I'm a much better controlled spender than I am when it comes to eating. So if you want to control your spending, the first thing that I want you to do is create 3 separate bank accounts. One bank account is going to be for your spending money. One bank account is going to be for your investing money. And one bank account is going to be for your saving money. And the reason why you want to do this is so you don't accidentally spend your investment money, or so you don't accidentally spend the money that's supposed to be saved, because now it's out of sight, out of mind. And now what you want to do is anytime you get paid, your money is going to go here. But then as soon as your money goes into this bank account, you want to automatically take some of this money and move it into this bank account, and automatically take some of this money and move it into this bank account. Many banks will automate this process for you for free. If you don't have a bank that allows you to do that, maybe you look for new banks in your area that will allow you to do that. But a lot of banks will allow you to create an automation like this completely free. And now you have a system of knowing this is the money that you can spend. If there's no money in here, you have no money to spend. The second thing that I want you to do is know how much money you can spend versus invest and save. And a simple place to start is something like my 75-15-10 plan, which says that from now on, for every dollar that you earn, 75 cents is the maximum you can spend, 15 cents is the minimum that you invest, and 10 cents is the minimum that you save. Now, if you're watching this saying, but Jaspreet, I'm spending 100% of every dollar that I earn. How am I supposed to now take some money aside and use it to invest or save because I don't have some extra cash? Well, I want you to think of it this way. If the government tomorrow announced that there's going to be a new 25% tax on your income, what are you going to do? You're going to kick, scream, complain, cry, and then you're going to figure out how to pay it. Same thing here. Now what you're doing is not giving money to the government, you're giving money to yourself to make yourself rich. Because now what wealthy people do, and what you're going to be doing, is you're going to pay yourself first. And by paying yourself, I don't mean going out and buying a new Gucci bag. I mean now using money to make yourself wealthy. Your investments are here to make you wealthy. Your savings are here to protect you against a financial emergency. The spending money is there to allow you to have the nice things, go on the nice vacations, eat at the nice restaurants, buy the nice cars, but this money is not going to make you rich. This money will make you rich. This money will protect you financially. This money will allow you to live your life. But you need to make sure that now you're not spending all of your money here. That way you always, no matter what, pay yourself first. You're always going to be investing your money because this is where you're going to build your wealth. Now, if your goal is to put aside $100,000, let's talk about what this actually means. Because if you're making, let's just say $50,000 a year, and now you're going to be putting aside 25% of your income, some of it's for investments, some of it's for your savings to build your wealth. That means that right now you're going to be putting aside $12,500. At this rate, if you put aside 25% of your income, assuming you don't get a pay raise, because if you get a pay raise, you're going to be investing more money and saving more money, because now when you get a pay raise, your investments also get a pay raise. But if you don't get a pay raise and now you're putting aside 25% of your income, well, it's going to take you 8 years to have that $100,000 put aside. Now, some of this is going to be in your savings account, some of this is going to be in your investment account, but now you have a solid plan on how you can put aside $100,000 in not that long of a time, assuming you don't get a pay raise, but there's more. Number 3, if you want to accelerate how fast you can put aside this $100,000, you can also let your money make you money. Because now when you're putting your money here to invest, this money is supposed to grow. Now, this doesn't mean it's necessarily going to grow by a certain percentage every single year, but you're putting this money aside here. That way it gets bigger. That way your money is making you money here. The money here in your savings account
probably isn't going to grow much. Sure, maybe if you put your money in a high interest savings account, you might get some return on your money, but this is where you really want to see your money grow. And if you know how to invest your money the right way, now not only are you putting money aside, but your money is going to be working to grow as well. That way now you're working to get a raise. That way you can give a raise to your investments and you can get a raise to your savings, but then your money that you put into this investment account is also going to be working to grow as well. That way this can grow even quicker so you can hit this goal even faster than 8 years. The two most common places where you can invest your money are into stocks and then into real estate. So let me talk about both and talk about the different ways that you can invest your money and different ways that you can actually get a return on your money. When you invest your money into the stock market, you're investing your money into a company. You're literally buying a piece of a business. Like if you go out and buy one share of the Amazon stock, you become one of the owners of the Amazon company. Now, the thing that I want you to understand here, that you don't have to go out and find the next Amazon or the next Google in order to make a lot of money. And this is the first mistake that so many people make when it comes to investing their money in the stock market, is they think they have to find the next hot stock. But the reality is, for probably 90 to 95% of people, you shouldn't be investing in individual companies. Why? Because most people don't have the interest or the education or the psychology to actually invest in individual companies. Because the reality is, when you invest in individual companies, if you really want to make money, you have to first understand, how do you actually analyze a company? What research do you do to keep up with the company? How do you keep up with the numbers? How do you keep up with what the management's doing? How do you listen to the earnings calls? What information should you be paying attention to? Most people don't care about that, and if you do care about it, well, a lot of people don't have the education or care about putting the education in to actually do that. And then if you are willing to do that, the next group of people don't have the right psychology to actually manage their investments, because the reality is market crashes happen. You're going to see booms and busts. And what ends up happening now to most people is they end up losing money in the stock market, when historically over the last 100 years, the stock market has gone up over the long term. Why? Because most people start selling and panicking when the market goes down, while smart and savvy investors are buying. And it's not easy to now actually do it. It's much easier to say it than actually do it, because now when you see your portfolio in the red, it can be very scary, and most people tend to panic, and then they make decisions based off of emotions, not financials. This is why most people shouldn't be going out and buying stocks, when the next best thing is buying something like a fund, potentially an index fund or an ETF. This is where now you're not investing in individual companies, you're investing into a group of stocks. That way now you don't have to worry about doing the research in individual companies. You don't have to worry about keeping up with all the companies. And now you just want to create a system where you're automatically buying some of these funds over the long term. Every week, every 2 weeks, every month, no matter what, you're just going to keep buying. If the market's booming, you keep buying. If the market's crashing, you keep buying. The only change that you'd make is maybe you buy even more when the market is crashing, because it gives you the opportunity to buy even more at a discounted price. Now I'm going to go over a few fund examples, but I want you to understand that, one, I'm not telling you what to buy, and two, investing has risks. You're never guaranteed to make money when you invest, which is why you need to always do your own research and never blindly trust a random guy on YouTube. So if you wanted to just invest your money in the stock market, you can invest in a fund like VTI. VTI is the total stock market ETF created by a company called Vanguard. What does that mean? If you go out and invest in the VTI ticker symbol, you're investing in literally the entire US stock market. So if you buy this one fund, you're buying a little piece of a lot of stocks on our stock market, which means essentially if the stock market goes up, your fund goes up. If the stock market goes down, your fund goes down. SPY is another fund which gives you exposure to the S&P 500. That means now you're getting exposure to the 500 largest companies on the stock market. SCHD is a fund that gives you exposure to dividends, dividend-paying companies. Now, I put a little asterisk here because, as a disclaimer, I do own SCHD. And so now the question is, how do you want to get paid, and what is it do you want to invest in? If you just want to throw your money into the stock market, well, VTI can give you that exposure. If you want to invest your money into the biggest companies in the stock market, SPY gives you that exposure. If you want cash flow, SCHD can give you that exposure. Now, this is where you have to start thinking, what type of investments do you want to make and how do you want to get paid? Because most people think of investing as, I'm going to put my money into this thing and then I'm not going to see this money until I'm 65 or 70 years old. I like to look at investing like, I want to invest my money into something and start generating some cash flow now. That's why the bulk of my investments, not all, but about 75% of my investments are cash flow producing assets. That means that I buy something and it pays me with cash flow. So the bulk of my stock market investments pay me with cash flow. The bulk of my real estate investments pay me with cash flow. I like cash flow just because it gives me cash in my hand today, and I can more reasonably predict how much cash flow I'm going to get as opposed to how much a stock or how much a real estate property or how much a business is going to be worth at some point in the future. If property prices and stock prices go up, that's icing on the cake. But I just want that cash flow because the cash flow gives me cash that I can use today. And now if you're working to build up $100,000, that cash flow is putting more cash in your account, or that cash is being used to buy you more shares. Because for me right now, with my stock market investments, the things that are paying me cash flow, I'm not using that money. I'm taking that cash and I'm reinvesting all of it. So I get the cash flow from my investments every 3 months because I get my dividends every quarter, meaning every 3 months. And then this money goes right back into the market to buy me more cash flow producing assets. So every week, the way it works for me is every week I have cash going into my funds. Then most of these funds are paying me with cash flow, which goes back into these funds to buy me more cash flow producing funds. So it's like a machine that's working to produce more cash flow while I'm throwing more money in there to buy more of the cash flow, which brings me to number 2, which is real estate. Real estate is one of my favorite places to invest because when you invest in real estate, now you're buying something tangible. You buy something that you can see, feel, and touch. You buy the bricks, you buy the land, you buy the windows, you buy the doors, and then you can also create cash flow. So now the way it works is you're going to go out and you're going to buy this property, and then you're going to rent it out to somebody else, and then somebody, that's supposed to be an arrow, somebody is going to come in and live in this property, and they're going to pay you rent. Now if you do this the right way, this rent should cover all of your expenses. That includes your property taxes, your insurance, your maintenance, your management fees, and cover your vacancy costs, and cover any debt that you might have, and then put some money in your pocket. Now, does this mean that every real estate deal is going to be profitable? No. This is where the research comes in because, well, right now you have a very hot real estate market, which means it's harder to find a good cash flow producing deal. Does that mean that there's no deals out there? No, it means you got to be pickier and you got to work to find the good deals. And this is where, again, that financial education comes into play. Now, should everybody be a real estate investor? Of course not. But it creates opportunity for the right people. Now, if you don't want to go and actually invest in real estate, there are funds that you can put your money in that will give you exposure to real estate properties. I have an example of one of my affiliate companies that allows you to do this down in the description. But this is where just understanding that you can get cash flow from different places, and then if real estate prices go up, well, that's icing on the cake. If real estate prices go down, well, at least you're still getting that cash flow. This is now where you have to make that decision of how do you want to invest your money. Do you want to invest your money and see the future growth, or do you want to invest your money and see the cash flow? For me, I like cash flow. That's why the majority of my investments are cash flow producing, and some are not. But you got to figure out what are the right investments for you. That way now you're working to put that money aside, but then your money is also working to make you more money. Now, if you want to go step by step on how do you actually make your first investment, how do you step by step start generating cash flow, even if you don't have a ton of money, we have a free ebook that we put together in Market Insiders that goes over how you can make your first investment, what investing is, how you can get started with investing, and how you can start generating cash flow. It's completely free, so if you want to read this ebook, I'll link it for you down in the description below. Number 4, I want you to manage your 2 S's, which is your spending and your saving. And I'll start by talking about saving because the reality is your savings are not going to make you wealthy, and your savings are probably going to lose value to inflation. If the interest rate that your bank is paying you is lower than what inflation is, your savings are effectively making you poorer. Now, that being said, that doesn't mean you shouldn't have any savings. That means you need to save your money strategically. That means you want to have somewhere between 3 months and 12 months worth of expenses saved up. Now, I know this is a big range, and the reason why it's a big range is because, well, it depends on where you are in life. If you're young, you don't have any financial responsibilities, you have more freedom to be more risky, and maybe you can take on more risk, which means you might only need a few months worth of expenses saved up. If you have kids, you have a spouse, and you're not really open to this whole idea of taking risk, and you don't like this idea of investing your money, and you feel safer with the cash cushion, then maybe you have somewhere between 6 and 12 months worth of expenses saved up. You got to find what's the right number for you, but somewhere between the 3 to 12 months of savings saved up here. Once you build that savings cushion, Now, you're no longer going to save money and you're going to reallocate that money here towards your investments because your investments are what's going to make you wealthy. But in order to do this, what I want you to do is look at your credit card statements, look at your bank statements, see how much money you're spending every month. Add up your rent, your mortgage, your utilities, your car payments, your car costs, your gas, your food, your eating out, your travel, whatever your costs are. Multiply the number by 3, multiply the number by 12, and that gives you a range of how much money you need to save. Once you hit that number, well, now you can stop saving that money. You can leave the bank account there because this is your cushion. Then you can start investing that money. The second S that I want to talk about, though, is how you spend your money. Because a lot of people assume that if you can buy something, that means you can afford it. But the reality is being able to afford something is very different than being able to buy something. Because if you have $100 in your account, you can go out and buy a $500 phone. But the reality is you can't actually afford that $500 phone or the $500 Gucci belt or $500 whatever, because financing doesn't mean that you can afford it. See, when most people think of affording something, they think I can just afford the payments. But now if you really want to become wealthy sooner, and if you really want to achieve that financial success that you want sooner, and you want to have to stop kind of spinning your wheels in this financial system sooner, you got to stop playing in the same game as everybody else. And that means you're going to have to control the way that you spend your money. And that means from now on, if it doesn't put any money in your pocket, don't use debt to buy it. The only exception to this would be the house that you live in. But if it's not putting any money in your pocket, don't go into debt to buy it. So what does that mean? You want to go out and buy a new car? Great. Don't get a car payment. If you want to lease a car, okay, well, you got to be really rich to be able to do that. Leasing a car is like going and flying first class. Flying first class and sitting economy is going to get you to the same place, but flying first class is a whole lot more comfortable. Leasing a car is very comfortable. It comes with a lot of perks, but you got to have the money to be able to actually afford that. That means if you can't afford to buy that car comfortably with cash many times over, don't even think about leasing it. So if you want to get a car, buy a car that you can afford with cash. That way now you don't have to worry about the monthly payments. Because now when you don't have to worry about the monthly payments, all of a sudden you're going to have a whole lot more extra money every single month. Because now not only are you not putting the money into the monthly payments, you don't got to pay for the premium gas. You don't got to pay for the expensive insurance. You don't have to pay for the expensive maintenance. And now you have a whole lot of extra money every single month. Yeah, maybe you don't have the BMW anymore, but you still got the extra money which can be used to make you wealthier. And now when you become wealthy, hey, go out and buy the BMW or the Benz and you don't have to worry about the price. So now we talked about how to spend your money the right way. We talked about how to invest your money, that way you can grow your money. We talked about how to save your money. And this brings me to number 5. If you really want to amplify how fast you can put aside the $100,000 or take it to $1 million or whatever it is that you want to hit, you got to earn more money. Because now if you want more money going into each one of these buckets, you need more money flowing in. As soon as you start doing this, you're going to love the idea of investing. You're going to see the potential growth. You're going to start running the numbers. You're going to say, you know what, this is cool. And yeah, you might start spending less. That way you have less money going out. That way you have more money to invest here. But there's a limit to how little you can spend. But there's no limit to how much you can earn. And this is where things really get fun, because when you understand this, now you're going to be looking for new and creative ways to earn more money. That way you can increase how much money you're putting here, because if you can grow from $50,000 a year to $500,000 a year, now you really can amplify how much money you're spending, investing, and saving. And the first time I say that, you might hear, Jaspreet, where in the world am I going to go from $50,000 to $500,000? Like, that's not even in the realm of possibilities. Well, this is where you have to start thinking a little bit different than what you might have been doing. Because now if you really want to start earning more money, you might have to create your own income. You might have to work to create a side hustle. Start watching YouTube videos on how to earn more money. Start reading books on how to earn more money. If you start opening your mind to the possibility that you can earn more money, now you might start taking actions on how you can earn more money. Because if we just keep doing the same thing every single day, you're just trying to earn more money from your job, maybe you'll get some pay raises here and there, but it's not going to be what you need if you really want to take it from $50,000 to $500,000. And if you want to 10x where your income is, you're going to have to start changing the way you think, and you're going to have to start changing what you do. But in order for you to do that, you have to believe it's possible first. And if you believe it's possible, well, then you're going to start putting in the action to actually make it possible. What are different things that you can do? Well, the internet has made starting a business or creating an income so much more accessible. This could be creating a product. This could be creating your own business. This could be working to provide value to other people on the internet. It could be a side hustle. You can be a freelancer. There are an unlimited number of things that you can do. Now, if you tell me, Jaspreet,
I hate the idea of being an entrepreneur. I hate the risk of trying to start my own thing. I hate the idea of trying to manage that type of stuff. Well, that's okay. You don't have to go out and start a business. You don't have to go out and start a side hustle. If you really don't want to do that, then now you want to find a more creative way of how you can earn more money. If you can't do it from your job, if you can't do it from your career, can you add on a second job? If that's not practical either, then how can you increase your income? Can you get a certificate online? Can you get some sort of certification online? Can you do some sort of education that will allow you to earn more money? There's a lot of online certifications that will take some time, that might cost you some money, that will allow you to earn more money. If you can start doing these things and maybe get a new career or find a new job that will allow you to earn more money, now the key is when you get a raise in your income, you don't want to just raise your spending without raising these. That's why we're following a plan that will scale with your income, because the biggest mistake that so many people make is that as soon as they start to inflate their income, they start to inflate their lifestyle without inflating their investments and inflating their savings. So as you start to earn more money and as you work to earn more money, you got to make sure that you're also increasing this and you're increasing this along with this. That's why you want to have a scaling route where now as you earn more money, you're also spending more, investing more, and saving more. That we're always paying yourself before you go out and make everybody else rich. Most Americans do not have $1,000 in their bank account right now to protect them from an emergency. Now, there's a lot of reasons for this, but if I can point out one thing that's holding back so many people from ever becoming wealthy, it's your car. You might think that you're the one driving your car, but in reality, for a lot of Americans, your car is the one driving you. I want to start by going over the real cost of your car. So the average new car payment in America is $554 a month. This is how much people are paying for a new car right now in America, and the average lease payment for a car is $487 a month. So I want to be conservative, so I'm going to do all the examples assuming we go with this lower amount. This $487 a month for a car. So you have the average person in America making something like a $487 monthly payment on their car, which will get you something like a $27,000 car. But the interesting thing about this car payment is your car is a triple threat. You are paying interest on a car which you have to pay to maintain every single year, which depreciates in value. What that means is, yeah, you bought this car as a $27,000 car today, but when it comes time for you to sell this car, you're not going to get anywhere near $27,000. Cars are liabilities. What that means is the longer you own it and the more you drive it, the less your car is going to be worth. You can compare that to something like a stock or a house, which are assets, where in general, the longer you own this thing, the more it's going to be worth. Cars, on the other hand, just take money out of your pocket every single month because you have to pay interest, you have to keep paying money to maintain it, and this car is losing value every single day. So you're paying $487 a month and you're getting a car with a heated steering wheel. That's pretty cool. But if you took that same $487 a month and you invested this money into, let's say, a low-cost index fund, that was paying a 7% annual return. So this is not something super aggressive. We're talking about an average 7% return a year. After 5 years, this $487 monthly investment at the 7% return would grow to $36,000, while the value of your car would come down to $11,000. So after 5 years, this is what your money would look like. Your investment would have been $36,000, but you wanted a heated steering wheel, and so your car is only worth $11,000. So this is what you get if you invest your money, and this is what you get when you want heated seats. Now, let's keep going with this. Let's say you do this for 10 years. So after 10 years, your investments won't be worth $36,000. They'd be worth about $87,000, assuming you get the same return. And your car and your heated steering wheel would be worth about $4,500. If you do this for 40 years, now, so 40 years, your investments would be worth over $1.2 million, and your car would be worthless. And by this time, who knows what's gonna be out? Heated steering wheels might not be a thing then. You might have some chip in your hands that keep your hands warm. If you have $500 to put towards your heated steering wheel every single month, but you don't have $500 to put towards your investments, something is wrong. And at this point, you're probably thinking, but Jaspreet, how am I supposed to get to and from work? Hold that thought. I'm gonna get to that in just a minute. But when we posted this concept on Instagram, where we said if you invest $400 a month and get a 7% return, you will be a millionaire in 40 years, we got two kinds of responses. The first kinds of people said, oh, I don't want to wait until I'm 40 years old to become a millionaire. And the second people said, where am I supposed to invest an extra $400 a month, Jaspreet? Let me start by answering the first part. But before I do that, I need you to do me a quick favor and smash that thumbs up button below, because at this point, a lot of people are getting triggered and probably smashing that thumbs down button. So if you want to help balance that out, help me by smashing that thumbs up button below. If you're given two choices, you can either be a millionaire today or you can be a millionaire when you're 70. I would pick being a millionaire today. Who wouldn't? But the problem is the majority of people are broke today, and they're going to continue to be broke or just above broke when they're 70. Baby boomers are in their mid 50s and mid 70s right now, and many baby boomers do not have any money saved for retirement. And if they do have money, it's nowhere near what they need to retire and live financially free, or even something remotely close to financially free. So yeah, maybe you don't want to wait 40 years to be a millionaire, but in my opinion, now I know, I'm just a random guy on YouTube, so what do I know? But in my opinion, I would rather be broke now and rich later instead of broke now and broke later. If I can't be a millionaire tomorrow, I'd rather be broke forever. By the way, if you're really concerned about waiting 40 years to build this type of wealth, you don't have to wait 40 years. There's other things you can do, and I'm gonna be talking about that in just a minute. Second, people kept talking about how they didn't have $400 to invest in building wealth in their future. Yet, you have $400 to invest into a heated steering wheel every single month, which is a money trap, which is keeping you broke, which is keeping you from becoming wealthy. And actually, the average person is paying a whole lot more than $400 a month, especially when you start adding in upgrades and premium gas and insurance. You're already spending this money. The issue is right now, this money is going into somebody else's pocket and it's making somebody else rich. It is not making you rich. So what I want you to do right now is shift where this money is going and put it into your own pockets. That way you can make yourself rich first. That way you can buy your dream car and not worry about the price. Car companies spend $35 billion a year to sell you the idea that if you drive a nice car, you're gonna have a great life, you're gonna have an awesome family, and your neighbors are gonna be jealous of you. But what they don't tell you is the real cost of your car, because the cost of your car isn't just $400 or $500 a month. The real cost of your car is your future wealth. I'm not saying don't own a car or don't drive a nice car. I want you to drive a super car. I want you to drive that luxury car. I want you to drive something nice, but I want you to be able to afford it first. That way you don't gotta worry about the price, and that way you're not sacrificing your future freedom. You need a car. I get it. What I'm saying is, do you really need a car that's costing you $400 or $500 a month? What I'd rather have you do is go out and buy a used but good working condition car with cash. That way you don't gotta worry about the monthly payments, and now you got a car that takes you from where you gotta go, and you got the extra cash in your pocket that can build your wealth. Leasing is almost never the smart financial decision, so leasing should be completely out of the question unless you are worth at least $1 million. Financing is never the smart financial decision when it comes to buying a car, because when you finance, you're paying interest to own a depreciating liability. Cars don't make money, they lose you money. And if you have to pay interest to buy something that is losing your money, you are losing money twice. You're losing money in the value of the liability because the car value is going down, and you're losing money by paying interest to own something that is losing you money. Buy used, use your extra cash to build wealth, and now when you have this wealth, go out and buy whatever car you want. It doesn't matter, because now you can afford it and the price doesn't even matter to you. Earlier in this video, I talked about how you can build this wealth faster than waiting 40 years to do that. Now, we talk a lot about this on our website, theminority-mindset.com, and I will also link an article for you up here and in the description below. But there's two things you can do to amplify this process. You can either invest more aggressively, that means put in more than $487 a month, or you can grow your money faster. If we're talking about investing more money, then you can either cut more expenses, that way you have more money to spend, or you can raise your income. That could mean looking for a new job or asking for a raise or getting a promotion. If you have more money, then you could put more money towards the investments. That way you can build your wealth faster. Or the alternative is growing your money faster than 7% a year. I said this 7% a year because this is a completely passive investment. If you went out and you threw your money into a low-cost index fund, which is a fund that gives you exposure to the stock market, now, you're not doing anything. You're just throwing your money into this fund and you're letting the stock market do its thing. This is where people say, oh, where are you ever going to see a consistent 7% return on your money every single year? And yeah, you're right. You might not see a 7% return every single year. One year you might see 4%, one year you might see 5%, one year you might see negative 2%, but other years you might see 8%, 9%, 10%. And so over the long run, this is what we've seen on average in the stock market. If you want to beat the 7% return, it's very possible, but it's not going to be as passive. This is a passive investment where you're just throwing your money into something and then you're walking away and you don't do anything and you just let your money grow. If you now invest your time along with your money, you can grow your money a whole lot faster. There's a few different ways you can do that to get the better returns. One way is to be more active in the market. So now you're trying to find growth companies and you're actively trading them. That way you can get a better return. It comes with more risk, but it also comes with the opportunity to make a better return. Or the alternative to that is you can start your own side hustle because now you're investing your money and your time into this thing, the side hustle that can grow way faster than 7% a year. If you took $1,000 and you went out and you started the side hustle, the side business, there's a chance that you can make the $1,000 back within 6 months. That's way better than a 7% return. And if you continue to grow it, that $1,000 investment that you put into your side hustle could become a $1,000 a month return, or it could be a $1,000 a week return. That is way higher than a 7% annual return with a passive investment. Now again, starting your own side hustle, starting your own business comes with risk and you can fail. But if you really want to amplify your wealth, there's only two ways to do it. You can either grow your money faster or invest more money. If you want to invest more money, you need to have more money. And if you want to grow your money faster, you got to take more calculated risks. Everybody says they want to be wealthy with their mouths. But the real question is, how bad do you want it? What are you willing to do to make it happen? If you're not willing to take the risks or make the sacrifices, I'm sorry, it's never going to happen.
The difference between a rich person, a middle class person, and a poor person financially is that a poor person buys dumb things with other people's money. A middle class person buys dumb things with their hard-earned money, and a rich person buys dumb things with easy earned money. Let me explain. See, what the average person does, the middle class person, is they are working to make money to do one thing: buy nicer things. The average person is working harder to drive a better car, to earn a bigger home, and to go on nicer vacations. Poor people, people who are not financially successful, want the nice stuff. Everybody does. And when you don't have the nice stuff, or when you can't afford it, what do? You put it on your credit card. Now you're having somebody else pay for that stuff, and now you have to spend the rest of your life paying off the Gucci, paying off the vacations, paying off the car. And so now you're playing this payments game where you have some of the nice stuff, but you're not buying it with your hard-earned money. You have to pay it back with your hard-earned money. But what rich and wealthy people do is they still buy that nice stuff, but they're not using their hard-earned money to buy that stuff. They're using their easy-earned money to buy that stuff. And what I mean by that is they go and generate an income, whether it's at their job or whether it's at their business. Does not matter. You go to generate this income. Then you take this income, and instead of going out and buying a new car, buying whatever stuff you want, you go out and you buy assets, something like rental properties, something like dividend-paying stocks, something that pays you with cash flow. Maybe it's even businesses. You make money, you buy assets, and then these assets will produce an income. And if it's in the form of cash flow, now you produce a new stream of income that's paying you every month, every quarter, every year. And then they use the money that their assets pay them to then go out and buy that dumb stuff. So what is a dumb item? Well, dumb things are things that do not put any money in your pocket. Your clothes, your shoes, your cars, your vacations, your home. All these are dumb expenses. Now, I'm not saying don't buy any dumb expenses. I'm saying if you want dumb stuff, make sure you can afford it. Because all these things are known as liabilities. Liabilities are things that take money out of your pocket and don't put any money back. Assets are things that you buy for the purpose of making money. And what wealthy people want to do is they want to make money to buy assets and then use these assets to buy liabilities. What the average person is doing is they're making money and then they're using this money to buy liabilities. And then what poor people, financial poor people, are doing
is they're making money and then they're financing these liabilities. Now, when I talk about your home, the reason why I talk about your home as this liability is because most people believe that your home is the biggest investment ever. If you are a realtor, you've probably taught this. This is what I was taught when I went through my realtor training. Mortgage brokers will tell you the same thing. But the reality is, your home is only an asset if you can sell it for a profit. But until you sell it for a profit, when you buy that home, not only do you have to make the mortgage payments, but you also have to pay for all the upgrades. You have to pay for all the maintenance. You have to pay for the property taxes. You have to pay for the insurance. You have to pay for the HOA. And you have to pay for anything else to take care of the property. And then you have to hope that you can sell it for a profit, which maybe you will be able to, maybe you won't be able to. We have seen the real estate market go up and down. 10 years ago, we were in a very down real estate market. Today, we are in a up real estate market. So real estate goes to cycles just like every other asset class. And if you are in a neighborhood or you're in an economic cycle that happened to be hurt when it comes time for you to sell and you have to sell it, you might end up losing money, especially when you factor in all the other costs that you had to pay to maintain that home. Now, I'm not saying buying a home is bad. I'm not saying that you shouldn't own a home. What I'm saying is if you want to buy a home, fine. Just make sure you can afford it first, because what ends up happening to so many people is they go out and buy a home thinking that this home is going to make them wealthy, that one day I'm going to pay down this home and pass it on. That's going to be my generational wealth, which is okay, but that's one of the worst forms of generational wealth that you can have, because if you are sacrificing your ability to actually invest money just so you can make a mortgage payment, you're buying a home the wrong way. This home is now a liability for you because now you no longer have the ability to go out and buy rental properties. You no longer have the ability to go out and invest in stocks. You no longer have the ability to go out and buy businesses or whatever it is that you want. It does not matter what investment you want to buy. But now if you're living paycheck to paycheck because you got to worry about making the mortgage payment, well, now you're doing it the wrong way. And this is where everybody says, well, I'm building equity in my home. Okay, let's talk about that for a second. Did you know that your mortgage payments are front-loaded, meaning if you go out and buy a home today with a mortgage, most of your mortgage payment is going to be going to interest in your bank's pocket today and tomorrow and the month after that and the month after that and the year after that and the year after that and the year after that. For the first about 14 years of your mortgage, the majority of your mortgage payment is going to be going directly into your banker's pocket with interest and not equity. It's about 14 and a half years into your mortgage, your 30-year mortgage, that now at least half of your mortgage payment is going to be going to your principal. So for the first almost half of your 30-year mortgage, most of your monthly payment is going just to interest. It takes about 15 years before you start making any significant contribution to your actual equity balance, or the majority of your payment going to the equity balance in your home. Is it bad to buy a home? No. But do not stretch yourself too thin to go out and buy a home, because what I would rather you do is I would rather see you stretch yourself thin to go out and buy more assets, to buy more investments, because that's what's going to make you wealthier in the long run. I met a guy at this conference that I was at recently, and he was talking to me about this problem that he had. He said, I'm running into a lot of financial difficulties, but they're very unique financial difficulties. I said, tell me more. He says that I am a very aggressive investor. I said, I like the sound of that. He says, I invest pretty much every dollar that I possibly can into cash flow producing assets like dividend paying stocks. I said, I like the sound of that. He said, the problem is I sometimes don't have enough money to eat. He's like, I came to this conference and I didn't have any money to pay for my parking meter. But at the same time, I got a notification on my brokerage that I got a dividend payment this morning. I said, well, you've already tackled the most difficult problem, because the most difficult problem for most people is getting that mindset to invest and then taking action to put your money to work and staying aggressive on it. Your problem now is you got to figure out how you can make more money, because what you've been doing is focused on just squeezing more pennies out of this pie. Where if you make $50,000 a year, you save and invest $10,000. Now you're spending 40, you're saving and investing 10,000. And then what happens to a lot of people is you say, wow, I like this investing thing. I like this idea of being able to build my wealth and grow my savings and grow my net worth. I want to do more. So what do? Instead of saving and investing $10,000, now you do $15,000, maybe $20,000. Now again, you're making $50,000 a year. Now, if you're saving and investing $20,000, you're only living off of $30,000, but you're investing a little bit more. It takes time for your money to compound and really grow, but there's a limit to how many pennies you can squeeze out of this limited pie. Because at the end of the day, a penny saved is just a penny. And once you understand this is a good problem to have, because now the next part is where things get really fun. Because now what you want to do is focus on the income side. This is what we were talking about earlier. How can you take this from $50,000 to $500,000? Because now, if you follow the same ratio, you can now live off of $300,000 and save and invest $200,000. You're saving and investing way more, but you also have way more money to spend. And this is where now that financial education is so important to understand. Number one, the key to becoming wealthy is to not spend your hard-earned money buying dumb things. Meaning, do not spend your hard-earned money to buy things that are losing you money. Use your assets to buy things that will lose you money. If you want to buy nice things like a watch, fancy car, fancy vacations, good. Some motivation for you. But use your money smartly. The more aggressive you can be to buy these assets, to buy the cash flow, the sooner that you will be able to afford that crazy stuff, the fun stuff, the dumb stuff without having to worry about the money. Now, does this mean you have to wait completely until you can buy it with your cash flow? No, not necessarily. But you have to make sure you're investing your money first. And this is where you got to figure out where on the spectrum are you. Are you going to be one of those people that's going to go all in and invest every penny possible and eat rice and beans until you can start making some real cash flow? Or are you going to start by making $100 a month into your investments? It doesn't matter where you start, but the key is that you have to get started. And this is where now you have to know, where do you want to go? Because once you know how to get there, the question is, where do you want to go? Because now you know wealthy people are working to have their assets pay for their lifestyle. Because now, even if you buy a whole bunch of dumb things, you got another check coming in next month, and the month after that, and the month after that, and this is money coming in without you even having to work. But in order to get that, you need the money to invest. So where do you get that money? Well, again, you can work through your job, or you can work to create your own income. But the key is that you have to be working to scale that income. That way you have more money to invest, because the more money you have to invest, the more income you're going to be able to get from your investments.
The thing that so many people get wrong about passive income or cash flow is they think that is the secret to getting rich, when in reality, cash flow or passive income is the byproduct of being rich in the first place. You have to have money, and then you can use this money to buy these assets that pay you with cash flow. The reason why so many people get scammed or screwed over on this whole idea of passive income is because they think that, oh, if I do X, Y, and Z, if I start day trading, if I start doing online surveys, if I start making YouTube videos, it is going to create passive income for me. When in reality, well, guess what? It's going to take a lot of work. And a lot of these things are going to cost you a lot of time. And a lot of these things might even lose you money unless you're willing to dedicate yourself to it. The way that you can generate true cash flow, true passive income, is you got to generate the income first. You got to generate the cash, and then you take this dead cash that's sitting in your bank that's not doing anything, and then you're going to put it to work by buying an asset. You're buying real estate, you're buying dividend paying stocks, you're buying a business, you're buying something that's now active, that's working to produce you cash flow. That's the way that passive income works. And most people don't want to say that because, well, everybody's lured to the idea of passive income. Because, well, who doesn't want to get paid while they're sleeping? Everybody loves that idea. But if you really want to generate that type of passive income that doesn't require your full-time effort, well, you're going to have to put in the work. And it's really funny when you hear people talking about how you can build this online business and it's going to be passive. Listen, I have an online business. It generates income. It generates income when I'm sleeping. But it's not passive. It's my full-time job. Briefs Media is my full-time job. Sure, sometimes we get sales overnight. Sure, sometimes we have sales deals come in overnight when I'm sleeping. But guess what? I run the company every single day. It's a full-time job. And so running a business is not passive income. People love the idea of passive income, which is why you see it thrown around everywhere on the internet. But the true passive, quote unquote passive income is owning assets, dividend paying stocks, owning real estate, getting interest from a high interest savings account in your savings account, or owning a passive business. That's what most people would really consider quote unquote passive income, but it takes number one, work to get there. And number two, you still got to manage your portfolio. I own a portfolio of real estate, and guess what? I'm still managing. I'm looking at my monthly reports. I'm looking at my quarterly reports. I'm meeting with my property managers regularly to make sure that the deals are still making me money, to make sure that these deals are still good. So yeah, there's still some level of work in it, but this is where the next thing you have to ask is passive income really what you want right now? And I remember having a conversation with a guy in the gym about this, where there was this young, I think he was like 24 years old, 22 years old, really young guy who told me that he wants to generate passive income. And I said, why? And he was like, I want to be rich. And I said, okay. Why? Like, what are you really trying to get at? And he was talking about how he loved this idea of not having to work for money. And I said, okay, well, let's talk about this. If you can generate, say, a 10% cash on cash yield on your money, a 10% return on your money, which is a really good return, especially in this economy. It's a really good cash flow on your money, meaning for every $100 you invest, you get $10 of cash flow or passive income, whether it's from stocks or real estate or whatever it might be. If you can generate a 10% return on your money, how much money would you need to be rich? And he probably said, I think like a couple $100,000 or something. And I said, okay, well, that means you would need $2 million invested into assets today. That way you can generate your $200,000 worth of cash flow. Is that really what you want to do right now? Do you have $2 million? And this is where now the question is, what are you really working for? I get it. People want financial freedom. Financial freedom comes from owning assets that pay you. But what is it do you really want? Because if you're an entrepreneur, if you have that hustler or I want to build a business mindset, your goal isn't passive income. Your goal is building a business. And then if you can build a business, you can build your income, then you can take the income or the sale of your business. You can take this money that you've earned, that you've built, that you've created, and then you can use this money to go out and buy the passive income. That's what's going to buy you the freedom. So that's where now you have to ask the question of what is it that you're truly working for? Do you want the passive income where you're just looking to create a new stream of income? That way you have this cash flow, so you have that financial freedom. Or are you looking to build that real richness right now where you're looking to build your income, you're looking to build your business, you're looking to build the valuation of what you have, that way you can sell it, or that way you own this big cash flow producing business, which isn't passive until you either sell it or until you hire a new CEO, but you're working to build this product, and then one day when you're ready, you can take this value, this business, and then you can go out and buy these 10% cash flow producing assets. And again, many times assets are not going to pay 10%, but just for a hypothetical. And so that's where now you have to start asking yourself and understand what's going on. There's nothing wrong with investing for cash flow. I love investing for cash flow, but my number one investment is into my own business. And the reason why is because when I invest my money into my own business, there's no limit to the types of returns that I can see. Right? When I go out and invest in real estate, which is my favorite way to generate cash flow, I also generate cash flow from dividend paying stocks. But if I'm investing my money into real estate to generate cash flow, my goal is to get a 7% cash on cash return, a 7% cash flow on my money. When I invest my money in the stock market, I'm getting dividends. Maybe it's 3 or 4%. When I put my money into a high interest savings account, maybe it's 4 to 5%. So we're talking 3 to 7% are the types of cash flow returns that I'm getting when I put my money into these passive assets. When I put my money into my own business, my goal isn't to get a 3 to 7% return on my money. My goal is to get a 10, 20, 30, 200% return on my money, because now when I put money into my business to hire more people, to invest in more softwares, to invest in more marketing. Now my goal is to accelerate the growth of the business. We're trying to take more market share. We're trying to increase the amount of products that we can sell. We're trying to increase the size of our business. It's a completely different game. It's not passive. I work every single day in the business. It's not passive at all, but it creates the opportunity for more income, which can then buy me more passive income. And I don't like using the terms passive income because there's always some sort of work required. I like the terms cash flow, but I'm just sticking with passive income because everybody on the internet is looking for this types of passive income. And this is what I'm trying to get you to understand is, what do you really want? If you just want the financial freedom and you want that type of passive income, great. Because you don't like your job, fine. Every time you get paid, put some money into these types of assets, the passive assets, whether it's rental properties, whether it's crowdfunded real estate deals, whether it's dividend paying stocks, whatever it might be. That way now you can start generating this cash flow, and you can do this. And every time you get paid with your cash flow, you buy more of these assets. You get paid with the dividends, you buy more dividend paying ETFs, and you just keep playing this game where you just keep working to buy more of these assets. Maybe you do it for a decade, maybe you do it for 2 decades, and you stick with it. You stay aggressive with it. You're working to spend less so you have more money to invest. You're working to earn more so you have more money to invest. Pretty soon, you're going to have a strong cash flow producing portfolio where you have enough income to fund your lifestyle, and now you can not have to worry about your job as much because now you have that cash and freedom. But if you are more the entrepreneurial type and you want to build that income, it's a completely different game. Now you're not playing for this passive income yet, per se. You're working to build the income, and then you can use the income to then fund the passive income as you grow that income, and you got to find that right balance for you. I don't invest in real estate the way that I used to because I have a better investment opportunity in my business. Now, if I see a good rental property, sure, maybe I'll invest in it. But my number one priority right now is investing into my own business because that's where I see the most opportunity for me.
He goes bankrupt. If that happens, now all of this money that you put into it would disappear because his company just went down the drain. And now this wasn't your fault. It was the executives at AT&T that ran the company into the ground because you were just hoping to build this money printing machine. But the executives at AT&T didn't do a good job, so now you have to pay the price.